Hi, welcome back to this series of SMSF Basics. And in this particular video, we're going to look at contributions. Now, this isn't necessarily SMSF or self-managed super fund specific. Contributions and what I'm about to discuss covers all types of superannuation. So hopefully you get something out of it. So I want to look at today just the really basic different types of contributions that can be made into super. And contributions is a really, really complex area. With each bit I talk about today, or each type of contribution, there's eligibility attached to each type of contribution. So it's really important you seek professional advice on if you're eligible to make contributions, or indeed if you've already maxed out or capped out with these different types of contributions. Just about every contribution that I talk about has a cap or an upper limit, and there's all sorts of eligibility requirements. So it's a bit of a minefield. You need professional advice, but what I want you to get out today is just a basic understanding of the different types of contributions. So there are two broad main types of contributions. The first is what's called a concessional contribution. So this is where money's contributed into super, and it's been done so pre-tax. So you haven't paid tax on that money, or there's a tax deduction claimed for a contribution going into super that you pay in personally. So we'll discuss that a little bit more. And that concessional contribution, when that money goes into super, then there's also a contribution tax. So it's this taxed environment you're getting. There's money going into super, and it's either going in pre-tax and you're paying a contribution tax inside super, or it's going in after tax but you're claiming a tax deduction for it while it goes into super, and then once again there's a contribution tax inside super. So that's the first main type, is concessional contributions, and I'll talk about some of the different types of concessional contributions in a moment. The second main type is what are called non-concessional contributions. So non-concessional contributions is there's no tax, there's the money you're putting in you've already paid tax on, so you've earned money, it's sitting in your bank account. What am I going to do with it? I'll put it into super, so it goes in with no tax deduction going in, and then when it gets inside super, there's no contribution tax to pay. So concessional contributions, there's usually tax on both sides. Non-concessional, no tax. So the main types of concessional contributions, and you should be aware of most of these. There's superannuation guarantees. So these are the compulsory amounts that are paid into your super by your employer on a regular basis. At the moment, at the time of this video, it's 9.5%. There's a few eligibility requirements to be able to have super guaranteed paid, such as you need to be of a certain age, you need to be earning a certain amount of money, etc. But in basic terms, if you're employed and you're earning some sort of wage working full-time over 18, you'll have compulsory amounts going into super from your employer. So that's called superannuation guarantee. So when that money then goes into super, it's a concessional contribution, you pay contributions tax, or the super fund on your behalf pays contribution tax. The second main type of concessional contribution is salary sacrifice contributions. So these are voluntary contributions made into super. You as the employee makes the nomination to your employer, hey, withhold some of my pay, I want to put that into super. And this goes in before you've paid tax on it, but when it hops into super, then there's a contribution tax. So salary sacrifice, it's voluntary contributions. The third main type of concessional contributions is what's called a personal contribution, or a personal concessional contribution. So these are voluntary contributions made by you, and they're made from after-tax money. So that is, the money's already sitting in your bank account, and you say, gee whiz, I'm going to make a personal concessional contribution. If you're eligible, you stick that money into your super, and you claim a tax deduction for it in your own name, but then on the other hand, the super pays a contribution tax on your behalf. So they're the main types of concessional contributions. So the other broad type of contribution I spoke about before was what's called a non-concessional contribution. So at the start or in my intro, I said the concessional contributions is sort of a taxed environment. You know, there's the money's either going in pre-tax and the super's paying contribution tax, or the money's going in to make a tax deduction with a personal contribution, and then you're paying, or the super fund on your behalf is paying a contribution tax. So non-concessional, there's no tax either side. So you've got effectively money sitting in your bank account. What am I going to do with it? Gee whiz, I'm going to put it into super, and I'm not going to claim a tax deduction for it. So that's sort of a non-concessional contribution. Now there's different caps on all that sort of stuff. So concessional contributions have caps, non-concessional contributions have caps. I'm not going to commit to a cap in this video because the caps change quite regularly. But it's a pretty easy Google search, or by all means contact us and we can sort of update you on those caps. So I thought I've given a snapshot there of the main types of contributions, and I thought I'd just take a minute or two just to list through or talk through all the main types or all the types of contributions you may have heard of, and just give a really quick snapshot on each. Now I've already spoken about quite a number of these, but just something I thought I'd run through, and a quick little comment, and just might be something that you can then go away and Google if you want more information. So a quick snapshot, super guarantee, we spoke about that. That's where your employee has compulsion to put money into super on your behalf. Spouse contributions, a spouse contribution is where you can elect for your employer to contribute money on your behalf to your spouse as a contribution. Pretty cool. Spouse contribution splitting, that's after the end of the financial year. You can make an election to split contributions to your spouse. Salary sacrifice contributions, we spoke about that. That's a voluntary contribution made where you go to your employer, hey Mr. Employer or Mrs. Employer, I want to make a voluntary contribution. Can you withhold some of my pay that you would have paid me already and put that into super on my behalf? So that's a salary sacrifice contribution. There's personal concessional contributions. So you've got money sitting in your bank account or wherever, and you think, gee, you know what, I'm going to make a contribution into super, and I'm going to claim a tax deduction for it. So that's a personal concessional contribution. Personal non-concessional contribution is the same thing as what I've just mentioned. Hey, I've got money sitting in my bank account, what am I going to do with it? I'm going to put it into super. But the big difference there is that you're not claiming a tax deduction for it going into super, and there's no contribution tax when it goes into super. There's catch-up contributions. So once again, on all these things I'm mentioning, there's certain eligibility, and that is definitely the case with catch-up contributions. So it's only relatively new legislation. In basic terms, and I suggest you Google this, but in basic terms, if you've got less than $500,000 in super, and you look back for 5 years, but it's only, I think it might be 1 or 2 years in now, so you've only got 2 years to look back. If you look back and you haven't hit the contribution caps for a concessional contribution, you can elect to make catch-up contributions if you can do so, and get more money into super than what you could previously before this bit of legislation came in. So catch-up contributions, pretty cool if you earn a lot of money and you've got the capacity to catch up contributions that you've missed. Work test exempt contributions, once again this is only really new, so the work test, for a really quick snapshot, if you're between 65 and 75 years of age, you can make a contribution into super so long as you meet the work test, which is you need to be gainfully employed for 40 hours over a 30-day period in the year you elect to make the contribution. So work test exempt contribution, they're effectively giving you another year. So if you're 66, you passed the work test last year, you can make a contribution this year. It's very new, suggest you get professional advice on it. Google it, do whatever you need to do, but there's a work test exempt contribution giving you an extra year. And I can hear all the 67 and 68 year olds saying that's not fair, why me, I've missed out. That's how it rolls. Downsize contributions, and I've still got 3 or 4 on the list here, believe it or not. Downsize contributions, so that's when you are of a certain age, and there's lots of eligibility around this. If you Google it, Downsize Contributions ATO, you can follow the stuff on the ATO website. Basically, if you sell your main residence, I think you have to have held the main residence for at least 10 years, and you can then, and you're effectively just selling your main residence and moving into something else. You can elect to put money into superannuation outside most of the other caps, or I think all of the other caps, and you can do so up to $300,000 each. So it's a pretty cool and not yet that well known contribution, but suggest, downsize a contribution. I think you've got to be over 65 to do it. Like I said, check the ATO site for eligibility, but over 65, main residents, I think for at least 10 years, you can put a big whack of money into super. So that's pretty excellent. There's a government co-contribution. So once again, there's eligibility around all these sorts of things. But basically, if you earn a certain amount of money and you put a certain amount into super as a non-concessional contribution, the government will match some of that, will match a portion of that and make a contribution into super on your behalf. Pretty cool. Low income super tax offset, once again, check eligibility, but if you're earning a certain amount of money and you've got a certain amount of money in super, the ATO will make a payment into super on your behalf. And I've got lastly here, and I've probably missed a couple, but lastly I've got small business CGT concessions. So there's a whole suite of legislation and eligibility around this, but basically if you meet the eligibility, if you're selling a business or an active asset associated with a business, you may be eligible for a small business capital gains tax concession, and part of that concession, or there's caps that you can put some of that money into super. Very complex area, but I guess in this video I'm just giving you a broad outline of the different types of contributions. Please seek professional advice on any of these sorts of contributions. There's eligibility requirements, there's cap requirements, it's very, very complex area. Can't stress strongly enough, please seek professional advice. We're happy to help and discuss any of these different types of contributions and their eligibility and their caps, should you wish. Thanks for watching, and all the best.